Hello there and welcome to the Oil Market Insight. This special program is brought to you here from Vienna on the occasion of the 154th OPEC conference. And I'm joined here now in the studio by some analysts who understand this industry very, very well, and we'll hear their thoughts. I'd like to welcome Jason Schenker, the president of Prestige Economics. Also Kate Dorian, who is the senior editor of Platts in the Middle East, and John Hall, the chairman of Energy Quote. So we have our esteemed panel in place here. I do want to remind you that the views that we will hear in this panel discussion are the views of these independent analysts and not the views of OPEC. So having said that, we'd like to get this started now. And looking at the state of the market, here we are entering the second half of the year. Prices holding up there around $70 a barrel, but also inventory still high, demand still low. Let me start with you, Jason, taking a sort of an overall look at this market. Tough challenges really at this time.
Yeah, I think right now the biggest risks are really for price to move lower in the next few weeks. We're in a period of shoulder demand where the U.S. summer driving season's over, inventories are very high, and economic growth in the U.S. and globally still looks weak. So these things are potentially price bearish in the near term, but as we look into next year and beyond, we see upward trends in energy prices and crude oil as we see economic growth turning around.
Now, Jason, you're based in the U.S. and have been very much following the market from that perspective for a while too. Are we really seeing, on the street, sort of real recovery coming back into place? We're hearing some sort of little shoots, we're hearing some good indicators, but I mean, what's actually going on in the U.S., the biggest energy consumer in the world?
Well, I think what we're seeing is that the economic data is not that great. You've seen some recovering numbers. If we look at a handful of manufacturing opinion surveys, the PMI numbers from last month I think of that showed the expectation that this month would be better than last month. But if we look at the service sector, that actually showed an expectation of contraction. If we look at the unemployment rate, it's at the highest it's been in 26 years. It's at 9.7%. And the scary thing is that unemployment lags growth, which means that the unemployment rate in the U.S. is likely to rise further next year. These things are not signs of a recovery. They're signs of potentially moving towards a bottom, and economic growth will recover before employment does, and that is likely next year.
And that volatility is, as we saw yesterday, coming back into the market. Jason, we're seeing a fall in the U.S. dollar really this week too. How's that going to impact the price?
Well, in general, there's an inverse relationship between the dollar and the price of oil. Put simply, when you have a barrel of oil in the world market, it's worth something, and you price them in dollars. If the dollar loses value in order to buy the same amount of stuff with your barrel of oil, the price of that barrel of oil has to rise in dollar terms in order for you to buy the same amount of stuff. So basically, as the dollar falls, this is supportive for the price of crude. How much further the dollar can fall now, I think, is kind of a big question. I think it's not likely to fall too much further in the immediate term because interest rate differentials are the main driver of foreign exchange. So in other words, when central banks lower rates, their currency weakens against other currencies. For the dollar, with the Fed already at bottom, it's more likely that other central banks that can lower their rates will see their currencies weaken against the dollar, not necessarily dollar strength, but other currencies might weaken further. This isn't likely to be supportive of crude because if the dollar looks like it strengthens moving forward, it's not going to be supportive. But other economic fundamentals, despite the high inventories, are likely to affect the price next year as we see the back end of the forward curve, the expectation of 4 or 5 years out, what's demand going to look like. If those expectations are really strong, 2012, 2013, 2014, those years look really good, that's going to pull up the back end of the forward curve, that's going to feed all the way into the front end and could pull up the price of crude as well.
Now, depending on who you talk to, and we just saw from Goldman Sachs, I believe, yesterday, they're looking at an increase in demand later in the year and again pick up next year, and they're now putting a higher price target on this. The demand has to come back when the economy recovers. I mean, it's a simple fact. Again, depending on who you talk to, there's different price targets out there and different views. Jason, what do you think in terms of what are you hearing that tends to be? Is there any cohesion among the analysts, among people out there in terms of where they expect it to go in a longer term?
Well, I think there's basically two camps in the short term. And one camp says if you look at the fundamentals, you look at the inventories, and you look at the way the market looks, and you look at the economic data, things don't look very bullish in the next few months. But I think most people would say if you look at 2010, or even if we think about prices now, the first quarter of this year, the average price was around $43 a barrel. Where we are now at $70, it's a huge rebound. If we think about the average price for this year, likely to be maybe around $60, next year above 70, and beyond that it's likely to rise. And I think most people would say, yeah, 2, 3, 4 years from now, you are likely to see on average the price go up. The other thing I think most people agree on is that you're likely to see increased volatility. You can get spikes high, and you can get a really quick rush down as well. But that trend is likely to be up with growth.
I see you just edging to get in here.
Yeah, no, on the fundamentals thing, I think the thing that most people often forget is, as I alluded to before, that this market has a forward curve, and you trade it in the future. And so current fundamentals don't necessarily justify where we are with price. But the future expectation is that 5 years from now we could look back and say, oh wow, $70 oil, that was really cheap. I mean, actually last year, if you had asked, people would have said $70 oil is really cheap. So these prices can move really fast, and I think if we take a long-term view, which is what the market you can trade on, those expectations of high prices in the future can pull up the current prices as well. And I think that's some of that you're trading the future price and yet you're also living in the present. That trade-off is, I think, what's keeping prices elevated to where they are.
Well, I'm afraid that's where we're going to have to leave it there, but we're very grateful for all of your views that you've actually shared with us today. And again, once again, for the OPEC ministers, their work cut out for them as they look at this market and see the short term, medium term, and the long term. So thank you so much from John Hall,
Thank you.
Kate Dorian, and Jason Schenker. Thank you so much for joining us. This has been Oil Market Insights, brought to you on the occasion of the 154th OPEC conference, coming to you from Vienna. Thanks so much for joining us.